Our money growing in our bank accounts is one of the biggest lies banks tell us. The fact is that while money increases in quantity due to interest, neither its value nor its value in real terms increase. Keeping money in the bank is actually costing you money because of skyrocketing inflation and subpar bank interest. Welcome to Financial Flipside. In this video, we'll outline 6 assets that you may use to halt wealth erosion and foster intergenerational wealth. Number 1. Safe haven currencies. Geopolitical stability is an important consideration when investing your money in the current world of fiat currencies, where no currency is backed by gold. The wealthy always store their money in Swiss banks for this reason. Switzerland offers a considerably more stable geopolitical environment because it has one of the strongest economic systems in the world. Because of this, the Swiss franc is regarded as a safe haven asset during unrest and volatility. We have repeatedly witnessed this. For instance, significant sums of money were transferred to Switzerland during the global financial crisis of 2008 and the Eurozone debt crisis of 2009 in order to stop the erosion of wealth brought on by currency depreciation in these nations. Additionally, the Swiss franc serves as a useful substitute for the US dollar in international trade. For instance, when the US imposed sanctions on Russian energy trades during the most recent Russia-Ukraine crisis, Russia carried out its transactions in Swiss franc. Such occurrences increased demand for the Swiss franc, which caused it to appreciate dramatically versus all other currencies. 1 Swiss franc was worth $1.1074 US at the beginning of 2023, instantly doubling the fortune of those who held the currency. Superior currencies like the Swiss franc, British pound, and Chinese yen are therefore excellent value stores. However, since not all of us are able to open Swiss bank accounts, smaller investors can obtain exposure to foreign currencies with as little as $100, thanks to currency, ETFs, and forex brokers like forex.com. Number 2. Industrial commodities, raw materials. Although scarcity is one of the factors that makes precious metals so-called valuable, these materials also have a natural utilitarian value, which makes them essential industrial commodities. For instance, silver is used to make electronics, medical devices, nuclear reactors, and other things. Similar to other metals, cobalt, nickel, and copper are in great demand in industry because of their inherent qualities that are difficult for substitute materials to match. To provide a much clearer picture, consider how rapidly cobalt demand has increased since 2020. The main justification is that it is essential for making batteries for electric vehicles. Its costs have climbed proportionally, from $20,000 per ton in 2012 to $40,000 in 2022. In just 10 years, there has been 100% growth. Exposure to these raw resources can therefore dramatically increase your portfolio during periods of high demand. But not everyone has the means to spend a lot of money on raw materials, store them safely, or locate suitable customers. Investments in mining-focused mutual funds, futures, and options, as well as equities of mining firms like Rio Tinto, are all excellent methods to get such exposure. Number 3. Land and real estate. For a very good reason, accountants view land as a non-depreciable asset. It is both rare and constantly in demand. Land has been one of the most precious resources on the planet since the dawn of humanity. We require land for a variety of purposes, including homes, factories, schools, farms, and office buildings. And since there are more people, demand will always rise. The same is true for buildings constructed on the land, such as houses, offices, and commercial buildings, which are constantly in demand. Therefore, in your investment portfolio, both real estate and land serve as good inflation hedges. In spite of a significant decline during the 2008 housing boom, property prices have tripled between 1992 and the 2020s, according to a Bloomberg report. Therefore, having exposure to real estate is always beneficial when the value of the dollar begins to decline. However, because they primarily consider real estate in terms of the home they live in, the majority of small investors only consider investing in real estate much later in their lives. We are now down to the last 3 assets. Are you now considering one of the assets that we have discussed? We have 3 more choices, so continue watching the video. Number 4. Sovereign guarantee. Have you ever given the dollar a close examination? The text on it states, "This note is legal tender for all debts, public and private." Ever pondered its meaning? The dollar has been recognized as legal money by U.S. law since President Nixon ended the gold standard in 1971. This increased its value as a means of trade, and we began to see it as a fair exchange for any item or service. Despite the fact that no fiat currency in the world is backed by gold or any other tangible object, they are nonetheless seen as being backed by the government's full faith and credit. Simply put, the government that backs your money determines how stable it is. Due to this, purchasing sovereign guarantee is a wise investment. Any country's government always pays its debts first. No powerful government will permit it to happen, because if the government defaults, the entire country will also default. Government securities, or G-SECs, are thus one of the safest ways to invest in national guarantees. Number 5. Value stocks and mutual funds. Cash returns are undoubtedly inferior to those from treasury investments. Although low risk is an important investment criterion, almost all investors seek larger returns, and stocks are a fantastic way to do that for risk-averse investors. However, because they are low risk, they give lower returns than stocks. Additionally, not all stocks are equally risky. In actuality, growth stocks and value stocks are 2 main categories of equities that make up the stock market. Since they deal with concepts and technologies that have high failure potential, growth stocks, like technology stocks, are riskier. In contrast, value stocks that deal in industrial metals, like Nucor, are less hazardous because there is already established demand for the foreseeable future. This is one of the most surprising assets, so let's now proceed to the last one. Number 6. Collectibles. This asset class includes antique cars, priceless works of art, finely crafted luxury handbags, limited edition timepieces, and even first editions of classic literature. Whenever you put a conventional car on the road, its price immediately drops by 50%. For antique cars, the math is reversed though. They appreciate in value over time, much like wine. In reality, a 1955 Mercedes-Benz 300 SLR Uhlenhaut Coupe was sold in 2022 for a staggering 135 million euros, according to Autocar. Since only 2 of these vehicles have ever been made, auto enthusiasts view them as rare collectibles. Similar to this, a Saudi prince paid a staggering $450 million for Leonardo da Vinci's most contentious painting, Salvator Mundi, at a Christie's auction in 2017. Because these one-of-a-kind items are timeless treasures of worth, the wealthy spend astronomically large sums of money on limited edition goods. If you can locate the appropriate buyer, they may sell for an unfathomably high sum. Collectibles investing, however, can seem like a distant fantasy to the average investor. Online stores like Whatnot are therefore great venues to sell collectible action figures, comic books, baseball cards, and much more. Additionally, on websites like Convy and Masterworks, you can invest in partial ownership of collectibles if you are unable to purchase the entire thing. Thank you for taking the time to watch. Show your support by liking and sharing this video. To stay informed on key financial topics, subscribe to Financial Flipside and switch on notifications so you'll know when new videos go up.